What is up, everybody? Welcome back to another episode of Bitcoin and Markets. My name is Ansel Lindner. Happy Friday. Made it to the end of the week once again. Hope you guys have big plans for the weekend. The last couple days in Bitcoin have been extremely adrenaline filled. At least the only thing missing is a big pump in price. But we have some big news with the SEC and the Ripple lawsuit. So we're going to go through a couple tweets on that. I'm a little bit late for the guys on Telegram that are listening. I'm a little bit late for my scheduled time because I was searching for a specific tweet that I read this morning and I could not locate it, but I did find a couple other tweets that we can take a look at. We also have a thread from Dylan LeClaire talking about disinflation/deflation, and we have that video from Larry Fink, another video this morning, and we're going to go over that as well. So lots lined up here. Let's get in here and share my screen. Bitcoinandmarkets.com. That's the home base for all my stuff. I put out Fridays has been my premier newsletter day. So I put out a big technical analysis letter where I look at forecasting and price, both near term, midterm, and long term. I also had a big section on this morning's issue about the dollar. And since we've seen the weakness in the dollar, what are my thoughts on that? What are some explanations? And is my thesis, is it flexible enough to take this? Because we did break 100 now on the DXY this morning. And that is, I remember saying a few months ago when it looked like it could have broken 100 back then, that I would start reevaluating at 100. And so we made it to 100 finally. And I did reevaluate it, and I wrote about it today on the Market Pro number 21, as you can see here on the screen. I also put out the blog post with all the charts and stuff that we use for FedWatch, because I do the FedWatch with Bitcoin Magazine on Thursdays at 12:30 Eastern, and then the next day I publish the blog post with all the charts and stuff. But that went out this morning as well to free members, everybody. Also, I have a free newsletter that goes out every Monday, and I cover that here on the live streams on the podcast series. So you can sign up to get that every week as well. You can also on the website support me monetarily if you get value out of my content. You can also find me on Fountain app, streaming sats, things like that. I appreciate everyone that supports the show. That's how I do what I do, is the people that support there on bitcoinandmarkets.com. Okay, so that is the website. Let's take a look at the chart. Look at this red candle. This is nasty. Nasty on the daily. I'm going to snap that, send it over to my guys on Telegram since they don't have video. You see the 50-day moving average coming up, 200-day moving average coming up very nicely. There's no threat of turning into a bear trend. It's not like we've hit some sort of cyclical peak at this point and we're going to be coming down. We've had a lot of these big daily red candles in the past, and the trend here has remained. So everything is looking okay. We're still in this kind of horizontal channel. Bull flag is what I'm calling it. You can maybe see faintly. Maybe I make this a little bit more solid. It could be a rising channel. The difference there would be that would be a little bit more bearish than a horizontal flag. So take that for what it's worth. It's right now. This is a bearish engulfing candle. That would be bad on the daily. If we go to the weekly chart, you can see how little damage this is doing to the overall chart. I mean, it does not look good with this huge wick at the top. We did have a bearish divergence. If I can put this up, bearish divergence on the weekly, and what that reminds me of is back in 2019, this bearish divergence over here in July of 2019, or at the end / beginning, I guess, first week of August 2019, that was a bearish divergence on that run up from the bottom. And, it took us months and months to get through that, another 6 months. plus COVID, getting into the halving before we eventually went up from there. So that was a big signal back then. And this is just kind of worrisome if that is going to repeat. Of course, history never repeats perfectly. It does usually rhyme, though. And I did on the Market Pro, I looked at different oscillators and indicators to see what is the relationship here. I don't think it's a perfect relationship, so that does give me some solace on this. But right now, this isn't looking super good on the weekly. But it's not a ton of, I mean, it's damage in the candle formation and in some of the indicators. But like you can see that the trend is definitely intact here on the weekly chart. Going back to the daily. Let's take a look at XRP because this has been in the news and it pumped, I guess, 50%. And it's back down off the highs. It got all the way, well, man, yeah, that's 50%, all the way to 95 cents. And now it's back down to 69 cents. So it's a roller coaster here for Ripple. Let's get into some of the news about Ripple. So let's see, where is the tweet? Here is one from Preston Byrne. The Ripple summary judgment is obviously not the last word on the issue. If Ripple Labs accepts the limited win here, which they won't, they're turbo effed because they've got multi-billions of dollars in institutional sales that they're on the hook for. So he is a Bitcoin lawyer. I believe he's out of the UK, and he's been around the space for many years, at least 2014, maybe as far back as 2013. So he knows this space inside and out. He also wrote eloquently at the time, back in like 2014, that all of these altcoins are most likely securities. So he has been around. He knows these tokens. He knows the way they have conducted these sales. He knows the law. Maybe he's not licensed in the US, right, to practice law, but he is a legal expert in his own country. So there is some validity to what he's saying here. And again, I wish I would have found that tweet from earlier, but I could not. It was a big, long thread from the pro crypto side, why this is such a watershed moment. I mean, almost immediately, Coinbase listed XRP again. And so I think that's probably a bad call. Anyway, here's what the SEC had to say. They responded to this court case, and they say, we are pleased that the court found that XRP tokens were offered and sold by Ripple as investment contracts in violation of the securities law in certain circumstances. The court agreed with the SEC that the Howey test governs the securities analysis of crypto transactions and rejected Ripple's made-up test as to what constitutes an investment contract, instead emphasizing that Howey and subsequent cases have held that a variety of tangible and intangible assets can serve as the subject of an investment contract. Further, the court rejected Ripple's fair notice argument, noting that the Howey test is clear and that claiming ignorance is not a defense to violating the securities laws. We'll continue to review the decision. Both sides are claiming victory here. It does not seem that it will be settled anytime soon. I don't think this was as watershed as most people are making it out to be. Most likely, this will continue to go on for years and years. Ripple has to continue fighting for all of these extremely, the horrible infractions that they had. That this summary judgment that could be spun positively for the crypto space. They're still on the hook for these billions and billions in fraud. So this court case is going to go on for a long time. We haven't heard the last word of it. They're going to claim it as a PR victory. They're going to cite it over and over and over in the news. And we're going to have to deal with this for another year or two, probably till the end of this next cycle, probably the next bear cycle. A lot of this stuff will be in the rearview mirror by that time. So that would be, 2016, or sorry, 2026, 2027, at the bottom of the next bear market, this will have worked its way through the system. And we will look back on this and be like, oh man, those scammers thought they had pulled one over on us, but no, they hadn't. Okay, what is next on this? So that was my update for Ripple. And this is something I ran across this morning. I did post it in Telegram. It's the multi-chain. Multi-chain was a big project. Okay, they had, can I bring up multichain.org if it's still up? They were trying to take it down this morning. Multichain.org. Hey, it's still up. So, multichain.org, it's supposed to be the ultimate router for Web3, guys. It's supposed to be, let's see, what did this say here? Okay, that's it. What else do they say here? Built for innovative cross-chain dApps. And dApps, of course, is short for decentralized applications. So this is an innovative decentralized protocol for decentralized apps, right? And it's leading to the multi-chain verse. It's a groundbreaking improvement towards further decentralization. They're really doubling down on this term decentralization, aren't they? They must have some really powerful, it's a powerful symbol of decentralization. Processes, multi-chain, cross-chain, bridging, and smart contract methods on other chains. This is gobbledygook, but they're pushing this decentralization. They are decentralized, right? I mean, look at all these supported chains. I mean, it's insane. It's like, how many Ponzi tokens can we support? You know, so that people don't run out of the Ponzi. They just go from one Ponzi to the other. It's like a intricately balanced multi-spectrum Ponzi scheme. That's what crypto is. And yesterday on FedWatch, I said something about, if they let Ripple off the hook, which is probably the worst offender of being a scam and being centralized and, just all around horrible project, the entire space is clean. And I don't see that happening. So something is going to have to, be reinterpreted by the judge in the final judgment, or the SEC can appeal and go up, I think, to like some sort of district court. So, I mean, there's lots of opportunities here for this to drag on for another 2 to 4 years, something like that. But anyway, let's read this multichain.org, multichain.org tweet, because this is what decentralization in crypto looks like, guys. This is what it looks like. So on May 21st, 2023, multi-chain CEO Zhao Zhang was taken away by the Chinese police from his home and has been out of contact with the global multi-chain team ever since. The team contacted the MPC node operators and learned that their operational access keys to MPC node servers had been revoked. So they could, it's so decentralized, first off, that they could, in the second sentence, they say, we contacted all the node operators. So it's like probably 20 node operators or something. I don't know. It's obviously just the setup itself can't be confused with decentralization, yet they're claiming it's decentralized. It's not even that. I mean, you can hide your centralization. You can try to hide it, but these people aren't even trying to hide it. They are just calling themselves decentralized. And when you say you're a centralized scam, you're liars, they say, why do you hate crypto? You're just a maxi. You're just toxic. When it's totally obvious. But it gets worse, guys. Furthermore, these MPC node servers, like all other ordinary servers, were actually running under Zhao Gung's personal cloud server account. Wow. No member of the team has access to his personal server account, so nobody can log in to these MPC servers. Later, the team established contact with Zhao Gung's family and learned that all of Zhao Gung's computers, phones, hardware wallets, and mnemonic phrases were confiscated by the authorities. Since the inception of the product, all operational funds and investments from investors have been under Zhao Gung's control. Wow, super decentralized and innovative. Remember, all of these crypto bros, Coinbase lawyers, CEOs, even the Gemini twins, all of these crypto bros are saying how much innovation is in this space. Web3 is so innovative. The multiverse, tokens, NFTs, these are so freaking innovative, guys. Does this sound innovative? All operational funds and investments from investors have been under his control. He had all central control of phones, hardware wallets, computers, and mnemonic phrases. All of the nodes were on his personal server account. I mean, does that sound decentralized and innovative? No, it just sounds like a scam. This stuff is trivial if you centralize it. The great thing about Bitcoin was that it was decentralized and it could still function. These scams have stolen the term decentralized, but use it to cover trivial centralized stuff. And they think that it necessitates a super high market cap. It's great innovation. It's just total garbage. So let's continue reading here. Due to the lack of information about the case, the team could only maintain project operation to the best of their abilities through remaining access on some non-MPC servers that hadn't been revoked yet, okay? Per the lawyer's suggestions, the team has chosen to cooperate as much as possible. That's good advice because you're dealing with the Chinese police, and obviously they can just disappear people. On May 30th, in a responsible approach toward the community, the team realized the news about Zhao Gung's disappearance. The team released the news about Zhao Gung's disappearance and informed the community about the technical issues it currently faced. So May 30th, and that is 9 days after his initial disappearance. It took him 9 days to release it publicly that the entire centralized party disappeared. Okay, let's fast forward another week. June 4th, Zhao Gung's family successfully logged into the cloud server using the historical information, so saved passwords on the computer. However, Zhao Gung's family only allowed multi-chain team engineers physical access to the home computers to fix technical issues with Router 2 and Router 5. During this period, Zhao Gung's family and the lawyer were in communication with the police. The team was not informed about the details of the case. Okay, the multi-chain protocol continued to operate as designed in a centralized way. The team made every effort with limited resources to sustain the operation of the multi-chain protocol and resolve user issues as much as possible. On July 7th, so this is June 4th, we're all the way up into July now. July 7th, user assets locked on the MPC addresses were transferred to unknown addresses abnormally. According to Zhao Gung's sister, login information from an IP address in Kunming was found on the cloud server platform, along with a series of operation transferring funds from the MPC addresses. On July 9th, so 2 days later, the sister transferred the remaining assets because they're getting drained. But then on July 13th, the sister was taken into custody herself. And so all the remaining funds, they disappeared. And then she supposedly went into custody. But most likely it could be that they just disappeared and ran away with the money. They don't have any, communication with the authorities. Due to the lack of alternative sources of information and corresponding operational funds, the team is forced to cease operations. The multi-chain team does not have access to the domain account to redirect or bring down the front end so they can continue scamming people and get people to buy these tokens, and probably Coinbase is letting people buy these tokens, and so that the centralized owner can just siphon money out constantly. But anyway, so that is Web3 for you guys. That's the innovative Web3 that's going to change the world. And we can't drive that type of Web3 innovation out of the US. That would be horrible to drive that level of fraud out of the US. We need to keep that level of fraud in the US, because if we don't, it's going to go elsewhere. Oh, man. Okay, so that was multi-chain. Let's get into some more fun stuff. And this is we've done Larry Fink on what network is this? Squawk on the Street is at CNBC. So he is talking up Bitcoin. Let's rewind it and play.
Can you talk about where crypto fits?
Well, I can't talk about Bitcoin because we have a filing with the SEC, so I'm prohibited. I can talk about crypto in general, and I can talk about what we have done. We believe we have a responsibility to democratize investing, and we've done a great job. And the role of ETFs in the world is transforming investing, and I think we're only at the beginning of that. I mean, we believe the fixed income market is going to become multiple $trillion in ETFs. Equities will continue. More and more, the market will be delivered through an ETF platform.
Sorry, guys. I'm going to try to refresh the screen, this tab. I don't know why it's shorting out like that.
We have a filing with the SEC, so I'm prohibited. I can talk about crypto in general, and I can talk about what we have done. We believe we have a responsibility to democratize investing, and we've done a great job. And the role of ETFs in the world is transforming investing, and I think we're only at the
My God. I think it's Restream or
beginning of that. I mean, we believe the fixed income market is going to become multiple $1 trillion in ETFs. Equities will continue. More and more of the market will be delivered through an ETF platform. If you think about what was done 20 years ago now with the advent of a gold ETF, that really democratized gold investing. It brought down the cost of transaction for gold. I mean, the cost of transacting physical gold is absurd. And now with crypto, the idea of democratizing that role, the cost right now to transact is quite expensive. We're talking points, not decimal points. And so that's a big point. Two, over the last 5 years, more and more our global investors are asking us about the role of crypto. And as I said, I do believe a lot of crypto is going to be, it's an international asset. It has a differentiating value versus other asset classes, but more importantly, because it's so international, it's going to transcend any one currency and currency valuation. If you just look at the value of our dollar, how it depreciated last two months, and how much it appreciated over the last 5 years, I mean, an international crypto product can really transcend that. And that's why we believe there's great opportunities, and that's why we're seeing more and more interest. And that interest is...
All right. So sorry about that, guys. There was a bunch of freezing on that video, but we got through it. Let's read what Bitcoin Reserve has here as highlights. And by the way, it is the afternoon thunderstorm has started. And, I have been live streaming around these times. Maybe I should pick the morning or something, but there is a possibility that the power goes out for, a flash when the lightning hits down the street or something. So Forgive me if the live stream cuts out, but we will continue until that happens. So here we go. Everybody is tweeting about the fact that Larry Fink says crypto instead of Bitcoin because of BlackRock's SEC filing. We find his democratizing and high transaction cost talking points more noteworthy. Yeah, that was. He's like, the cost of transacting gold is just insane, which is true because Bitcoin can be sent anywhere in the world in 10 minutes for a relatively low fee, especially as you get higher value of the transaction. Like $1 million transaction for even $100 fee is minuscule compared to how much it costs in the traditional system. So here, take this certificate and let us hold that valuable asset for you. Makes it so much easier. Sounds familiar, doesn't it? Bitcoin was created to remove financial institutions as third parties. Letting BlackRock, Prime Trust, or Binance hold your Bitcoin strips away all of its unique qualities and leaves you with an IOU. So yeah, that's Bitcoin Reserve helps you self-custody. But what else did Larry Fink say there? He said that it's an international asset. It has the ability to transcend national currencies, just like gold. Okay. So maybe he's not putting it quite in the exact terms, but gold was the money, and all the other national currencies were denominations of that money. So you had $1 was an amount of gold, a pound was an amount of gold, a mark was an amount of gold, right? And so you had all of these different denominations of the money itself. So the gold transcended national currencies, where now we don't have a backing. It's a dollar is a dollar. Euro is a euro, right? And if we go back to a commodity money with Bitcoin, Bitcoin has the opportunity to transcend national currencies. So he's talking about repegging to Bitcoin. This idea I've kind of talked about for just every once in a while, mentioning it for years and years. But I think that's the end game here, is they are going to back the dollar and and then necessitate backing all other currencies by Bitcoin. So all of these calls for $1 million Bitcoin or $10 million Bitcoin, really it's how many sats per dollar are we going to be at? Where are they going to peg it? Could they peg it at 100 sats? Well, it depends how soon they do it. I mean, if they did it right now and they pegged Bitcoin at 100 sats or 100 sats per dollar, that would be $1 million price tag. And all the value differential between here and $1 million for the Bitcoin price, that would be a gain to holders. So if the government is holding a bunch of Bitcoin and then they revalue it up like that, then they would get all that value. So anyway, if they make it 10 sats per dollar, whatever, then, that's how they're going to do it. And in that case, let's say the US government buys 1 million Bitcoins and they revalue it up to $10 million of Bitcoin. That is pure ability to pay off the debt, right? The debt wouldn't matter anymore, because what they would do is they would just value Bitcoin in a way to make the debt payable. I hope that makes sense. So I think that's a real possibility. And Larry Fink, it's just amazing, this turnaround. He's obviously out there marketing his new ETF, hoping it will get approved. But he is on, it seems like once a week, talking up Bitcoin now. This is such a 180, and it's so bullish. I can't believe that the price of Bitcoin is not reacting more positively to this development specifically. So, okay, let's go on to the next tweet, and this is from Dylan LeClaire. I will do an admin break here real quick, guys. So Ansel Lindner, Bitcoin and Markets. I'm live streaming on YouTube, Rumble, Telegram, Twitter, and Twitch. You can find me at bitcoinandmarkets.com. The Telegram is t.me/Bitcoin and Markets. That's where I hang out most days and where I interact the most, other than on Twitter. So anyway, yeah, let's get into this tweet from Dylan LeClaire. Good analyst, great young Bitcoiner. He has a very bright future ahead of him. I'm glad that I know him. But here we go. Dylan LeClaire. Disinflation is here. What could it mean? Long form post. Number one, disinflation is in motion. So just to clear up, disinflation is the slowing down of the rate of change. We really don't have that. The rate of change has slowed, and the year-over-year number is misleading because like a average speed, okay, it's not exactly the same, but this is a good kind of analogy. The average speed of a car, and let's say you take that average speed every second, and then the last 12 seconds, you average that to get the speed of the car. That's kind of how year-over-year inflation is. Not exactly, but go with me here. And when the speed, like let's say then the car hits a brick wall, it goes to zero. It will look as though it is slowing down if you take the average speed over the last 12 seconds. It'll look as though it's slowing down, even though it didn't slow down, it stopped completely, right? So disinflation is this year-over-year magical illusion that we have that inflation is actually slowing down. No, inflation has pretty much stopped. It made a significant qualitative change from about 1% a month middle of last year to right around 0.1% a month. And it changed instantaneously pretty much. And everything else is a fluctuation around that mean. But no, it's not disinflation. It has already instantaneously disinflated, I guess, whatever the term is. And then the year over year is just catching down. So anyway, I just wanted to clear that one up. But disinflation is in motion. Sufficiently tight Fed policy is doing its job. Okay, I know this is just the second sentence and I'm blabbing on, but no, I mean, what's the correlation does not equal causation, right? So yes, the Fed tightening policy correlates with its stated goals happening, but that doesn't mean that it caused it. It doesn't mean that it's doing anything. It just means that it happened to coincide in time. And that's not that hard. Every 6 weeks, they have a Fed funds or FOMC meeting. They can look at the data and they can adjust their narrative. And their narrative is very boilerplate where they just change maybe 1 or 2 sentences max, or even a few words in their statement. That's it. The economy is a big lumbering beast, and it doesn't just shift on a dime. Things build up and build up and build up. And if you collect enough data, you can kind of see these things coming, and the Fed just positions its narrative to look like it's doing something. But correlation is not causation. Okay. As evidenced by the 1 and 3 month annualized sticky CPI decelerating meaningfully. Focus from market participants should be shifted from inflation to the reality of the tightest monetary policy in 15 years. Okay. Sure. I don't like the usage of the term inflation here because it was CPI. But anyways, let's keep going. High inflation / CPI, particularly in the core basket, X food and energy, masked the effects of the fastest tightening cycle in history. A tight labor market fueled the flames for higher wages, which hadn't really increased all that much. Second half of the inflationary impulse wasn't energy driven. It was instead fueled by wages in a tight labor market. Maybe, but we have war in Europe starting in February of 2022 with massive sanctions. Every couple months, they put on more sanctions. So you had this rolling effect on supply chains, on supply versus demand. That would be what I would say. It wasn't fueled by the flames of higher, or it fueled the flames for higher wages. the labor market, I mean. And then the impulse wasn't driven by, well, Jesus, wasn't energy driven. It wasn't necessarily energy driven. It was sanctions driven. So we had COVID. Then before the world could even get back to normal after COVID, they have all these sanctions that they put on the world. So that is what fueled the second half of the inflationary impulse, was the war and the sanctions. You had to reroute natural gas from the United States to Europe. They rerouted Russian energy to India and China. So like the entire global economy had to be reworked. That's what fueled the inflationary impulse, the secondary one. Okay, real yields using both trailing 12-month inflation and forward expectations are the highest they've been in decades. This isn't the 1980s. Debt levels don't allow for sufficiently positive real yields for long before things start to deteriorate. Okay, I agree with that. Take a look at previous Fed tightening and cutting cycles. There is a reason that much of the pain in equity markets is felt after the Fed starts cutting. Okay, let me read that again. Take a look at previous Fed tightening and cutting cycles. There is a reason that much of the pain in equity markets is felt after the Fed starts cutting. Is the Fed causing distress by lowering interest rates? Obviously not. They are merely attempting to ease the pain from the second and third order effects of sufficiently tight monetary policy. Not really. I think that the Fed moves because they are trying to stem the panic. For example, in 2019, the stock market actually continued, equities actually continued higher. Even though we had the repo rumble and there was no bids on U.S. Treasuries, and the financial system froze for like 10 minutes in the morning or something like that on September 16th or something in 2019. And the equities continued higher even though the Fed started cutting. So that is the first time that we have results of post GFC cutting like that. Okay, that's very important as post GFC because everything changed in the Great Financial Crisis. That was the end. That was the peak of the global credit bubble. And ever since then, we've been managing the decline. The first few years after that, we could rely on China to continue to stimulate the economy with growth, the global economy with growth. That's over now. So now we're managing the decline. And so the only thing that we have to go off of is really 2019. And 2019, they cut and the equities continued higher. You can't look at a market from like, say, 1981 and compare it to today. It's a completely different financial system. So the Fed causes distress by lowering interest rates? No. They're trying to keep the market from freezing and reliquify the market. That's what they're trying to do. Because what happens is there are some people out there, they need cash and they can't sell their treasuries. Why? Not because the treasury is bad, but because the institution is bad. That bank, the people don't trust the market. All the other players in the market don't trust that bank. So they won't do business with them. Even if it's with a treasury, there's no haircut high enough because now they're stuck with maybe an illiquid treasury because the entire market freezes up. If one bank freezes, then the next one freezes, the next one freezes. So it instantly goes no bid. Even though the face value, I mean, it's risk-free because the government can make you whole. So the Fed tries to reliquify that market. That's what happened in 2019. That's what happened in 2020 with COVID. It's the same thing. That's what they're going to do. So we can't look at long time history. We have to look at the most recent stuff because that is the most comparable in the working of the financial system, because the financial system evolves. All right. It grows and it changes, just like Bitcoin is growing. The Bitcoin market is growing. There's different connections within the infrastructure, within the plumbing, who owes what to whom, who does business with whom. That's all constantly changing. Same in the traditional system. It's constantly changing. They're inventing new products, like they invented the mortgage-backed security, right? So everything is constantly moving and evolving. And you can't look at something 50 years ago and say that we can map that onto today. You just simply can't. Okay, let's go down to number 5. Disconnect between bond markets and equity markets is large and growing by the day. Okay. It's understandable that equity earnings would be in favor relative to bonds during an inflationary regime due to pricing power advantage of equities. Due to pricing power advantage of equities. But with disinflation now underway, the growing divergence between equity multiples and real yields can no longer be ignored. This can also be seen through the equity risk premium, equities yields minus bond yields. Okay, he's probably right on this. All right, he is more astute at these type of models than I am. And a lot of people are starting to catch up with this disinflationary / deflationary trade. Okay. What I bring to the table and what I point out, which I don't think he is taking into consideration, is a basic framework that describes, that you can rely on to forecast and describe how these things are going to evolve. I don't really care about equity multiples and real yields. I mean, if I was a portfolio manager, I would, but I'm not. I'm a macro forecaster. And equity multiples obey the underlying framework. They have to stay within a regime. Real yields have to stay within a regime. That's why when you see things get to extremes, they come back the other way. You know, if you get towards historical highs in some metric, it's going to come back the other way, because the economy works on a series of complex pendulums back and forth. So he could be right on this, but I don't think this is the correct way to forecast what's coming, especially in the pivotal times, you know, because if you look at when things start happening suddenly, you know, you say gradually, then suddenly, usually they happen suddenly to swing back the other way, to stay within the framework, and to the pendulum comes back the other way. You can't predict those type of things by looking at the numbers. You have to have a framework. But anyway, let's continue. In equity markets in particular, the FOMO is real, with the latest round of buyers being lots of long only funds. Okay, long only funds caught offside, sitting in cash, and plenty of retail. And this is what I said. I said there was a lot of dry powder on the sidelines in 2022, moving into 2023. And that was one of the factors for why I was bullish on equities. Not only that, but a return to the mean, right? And a return to a asset price inflation environment. Asset price inflation. There is such thing as asset price inflation. It's literally inflation, because that is where new credit is focused into asset prices. So the only game in town becomes asset prices, because that's where the credit is flowing. The reason why credit is focused versus all over the economy is because we're in a deflationary pressure, where the economy wants to deflate and crash, but it can't, because of all the mechanisms that pump credit into asset prices, that banks lending to each other, having stress tests, having the Fed build a narrative of somewhat confidence in the market. But the overriding pressure is towards credit collapse. So, but credit has to be created. It has to be growing or it's dying. And so it gets focused into those asset prices. That is why the FOMO is happening in equities, because of this monetary property, the monetary way that this system works, not because of equity multiples. Okay, think about this, like the PE ratios and stuff, they are out of this world, or they were back 2020, 2021, and historically super high and everything. And now I lost my train of thought. Oh, Jesus. But so the equity PE ratios were super high. But that's because we're in this asset price inflation regime, and stocks become the only game in town. I mean, stocks, real estate, bonds. It's not home equity. It's not business loans like to mom and pop shops. It's not just loans within the economy to move things along and to build and grow. No, it gets focused into certain things. That's why we have asset price inflation. But anyway, I kind of lost my train of thought on that point. But let's continue. Looking at what's fueling strong earnings surprises and a resilient U.S. consumer, look partially to excess savings. Oh man, I'm messing this up. My eyesight's going. Looking at what's fueling strong earnings surprises and a resilient U.S. consumer, look partially to excess savings. COVID-era financial stimulus remains in the coffers of the U.S. consumers, but the distribution of those excess savings is key to monitor. All right. Quote, we estimate that the top income quintile currently holds just over 80% excess savings. The 0 to 20% and the 20 to 40% quintiles have already depleted their excess savings balances, while the 40 to 60% quintile will likely follow in the next month or so. All right, very interesting. With consumer savings running dry for all but the upper class, expect the resilient consumer of late to begin to feel some stress, with student debt obligations restarting at the same time as excess savings running dry, with possible expected labor market weakness on the horizon as well. Very interesting. We did have the thing from the Biden administration. They're trying now to forgive 800,000 people's student loan debt, do an end run around the Supreme Court decision. So that might be taken out of this. But yeah, good points. Final point, number 8. I've admittedly been pleasantly surprised by the strength of the U.S. economy and the equity markets in particular so far in 2023. Very interesting point. Most people, and I think Dylan would put himself in this camp, were bears. They were stock market bears. There's not very many people out there that were stock market bulls going into 2023. Nobody that I listened to. I mean, even Jeff Schneider and some others, they have been bears for a couple years now. And that's because you had to have the proper framework. And you can't tinker around, use someone else's framework that hasn't been predictive, tinker around the edges by getting some more data, and you think more data is going to help your framework predict properly. No, you need to change your assumptions. You need to go back to the drawing board and say, what the hell? How does money work? Anyway, let's continue. The recent bull parade, especially following the cool CPI print this week, has been especially interesting to me. Meme stocks are back. NVIDIA is the new Tesla, and shorting vol is once again a path to infinite riches. All is right in the world. Yes, this is a return to post-GFC normal, guys. A return to post-GFC normal. In the midst of it all, however, I cannot escape the thought that some of the recent celebrations and fist pumps may be a bit premature. If history is, okay, here is history again. If history is to serve any sort of precedent, this cycle is far from over, as the fun doesn't even begin until the Fed starts to cut rates. Okay, let's look at these charts here. Actually, I'm going to pull up my own chart. So this is the S&P 500. Holy cannoli. This is going insane this year. NASDAQ is even worse than this. But what I wanted to point out was, no, not that. I want to bring up the Fed funds. And I'm going to set it to move to a new pane above. We'll just close that down. All right, so here we go. Let's go back to 2019. And we'll see. Where are we? Okay. Let's take this box off, and I'll use this arrow. So 2019, we have here in August, they're starting to cut. Stock market continues higher. They cut again in September, stock market continues higher. They cut again in October, stock market continues higher. Then, of course, in March, that's when COVID hit, and that's finally when the stock market gave up. But this whole hiking cycle here, cutting cycle in 2019, the stock market continued higher the whole time. And that is the only real rate cutting cycle since the great financial crisis that we have as a comparison. But let's look at this. So we'll go just kind of a median right here up to the top. The stock market rallied another 15% while the Fed was cutting rates in 2019. So very interesting. All right, let's go back to that. I think it was pretty much done. But yeah. So anyway, I know I disagreed a lot with Dylan there, but I was using this as an example to highlight my kind of unique framework, my idea of deflation and how I was able to call transitory CPI the whole time, and why others, they're starting to come around to this. I think it's very interesting. They're as late as the Fed. Most of these analysts, I'm talking like Luke Gromen and stuff, not necessarily Dylan. He's probably better than Luke Gromen. But a lot of these analysts, they are just behind. They're as behind as the Fed. You're starting to see this disinflation. The next big thing is going to be talking about recession. Recession is going to be, everyone is going to throw up their hands and be like, oh my God, the world's ending. Recession is nigh. This is going to be the worst recession since the Great Depression or whatever. And I don't think it's going to be the case, because they can always extend and pretend. They will extend and pretend just like they did in 2019, 2009. They'll continue to extend and pretend. Now, other countries is a different story, but I think the U.S. Will have a mild recession. That is still my main odds are on a mild recession, and then equally split between 25% of possibly a hard recession and 25% possibly no recession at all, no actual textbook recession. So anyway, guys, that's where I'm going to leave it today. This was kind of a rambling Friday live stream, but I am live streaming on YouTube, Rumble, Twitter, Telegram, and Twitch. So you can find me anywhere there. If you're watching on Rumble or YouTube, make sure you like, comment, and subscribe. Thank you. That helps everybody else find the channel. Check out bitcoinandmarkets.com and become a member to stay up to date with all of my content. Thank you guys for hanging out. Hope you have a great weekend, and I'll see you on the next one. Bye.